Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Today on the show, we've got Bob Elliott. He is the CEO and CIO of Unlimited Funds. But before he started that a couple years ago, he was the head of research at Bridgewater, one of the largest hedge funds on the planet. Except while he was there, he started to think maybe one top hedge fund isn't all that different from another top hedge fund, and yet they're all charging pretty high fees. So he decided to start his own company where he replicates hedge fund strategies at ETF prices. We talked a lot about the data that supports this initiative, but also how he's thinking about macro at a time where we're in a big data vacuum and the Fed is maybe as disorganized as it's ever been. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof, from tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Bob Elliott, thank you so much for joining me on the podcast.
Thanks so much for having me.
So you are ex-Bridgewater and you set up your own shop around 3 years ago. And you are focused on kind of the macro machinations of the market, which I'm so excited to dive into with you. But first, just at a high level, a lot of people are already familiar with you, but talk to me about the premise and what you're looking to accomplish through Unlimited and the set of various funds that you have.
For many years, hedge fund style returns have really only been available for a small number of institutional investors. And even amongst those investors, a lot of them are sort of stuck paying the type of 2 and 20 fees that erode the returns and really make for the fact that most hedge fund managers, they take most of the alpha that they generate. The old joke that that where are the customers' yachts is very applicable in the hedge fund industry. And so after years having been in the hedge fund industry and recognizing this sort of dynamic, I realized that basically the future of hedge fund strategies was going to be manager diversified, low-cost indexing in the same way that, it's totally revolutionized the way that people invest in stocks and bonds and other long beta assets. And so I started Unlimited a few years ago with that sort of core idea, although because investing directly in those managers means you got to pay them the fees, plus you got to pay yourself something. We took a different approach, which was to build technology that allows us to replicate how those managers are positioned in real time. And then we can take that understanding and package it into ETFs. And so that's what we've been working on for 3 years now, showing in real time that our technology works in terms of tracking their positioning and then building products from that technology that give all investors low-cost access to those hedge fund strategies, which are over time likely to improve their portfolio return.
Okay, so that's really interesting. You're not replicating a hedge fund in the ETF like your own hedge fund. You're replicating strategies that are already out there. I'm curious, how do you choose which strategies or which fund managers to replicate?
Well, one of the dirty secrets about the hedge fund industry is that once you get to sort of the institutional quality hedge fund, so one of the sort of 3,000 main funds that exist in the world, your performance is no better than your peers. And that's a really important point. Of course, in any one year, it might be better. In any one year, it might be worse. But over time, basically, there's no indication that there's individual manager outperformance persistence beyond random chance. And so if that's the case, you're actually a lot better off trying to replicate the index of hedge funds to generate a more consistent return than either trying to be on your own a better hedge fund than others, because that's a Sisyphean task. You'll never do it, or trying to pick the winners. And so what we really focus on, in the same way, it's, it's challenging to pick one stock of the S&P 500 that might be successful. In this case, it's challenging to pick a single manager that will be better than its peers. And so it's way better off focusing on replicating the index of hedge fund managers and how sort of that wisdom of the crowd is positioned, rather than trying to pick any one individual manager or subset of.
Oh man, no wonder you left Bridgewater. That's an uncomfortable thought to hold while you're the biggest hedge fund.
I've angered a lot of hedge fund managers by presenting this information to them. In fact, the group that has blocked me the most on Twitter are actual hedge fund managers when I suggest to them that the empirical evidence suggests that they are no better off than their institutional peers. And what's amazing is you sort of present this information, and I've done a study of 20,000 hedge funds over decades of performance, which shows this not only in aggregate, but by strategy, by size, every way you slice it. I've demonstrated this with empirical evidence. And when you ask these managers, okay, what is your empirical evidence that you are better than your institutional peers? It is crickets. It's as if all of these, serious quants who every day work hard to ensure the highest statistical standards in every analysis and trading strategy that they implement, when you start to talk about how is your performance different from your peers, it's like that's all out the window. And to be frank, it's all emotions. That's what you get back. Just anger and emotions at your, at the statistical research that I've done, the quantitative research I've done that proves that there is no manager outperformance persistence beyond random chance.
Oh man, well, I mean, that must be a knock to the ego, and people don't like numbers that don't support their ego. And I guess to be clear about your premise, you're not saying hedge funds are useless. You're just saying like one hedge fund over another is useless when your goal is outperforming the market, right? So you still think hedge funds have this ability to outperform the market?
Yeah, I mean, hedge funds generate lots of alpha, plenty of alpha, right? And of course they should, because they invest billions and billions of dollars in developing unique alpha strategies that are taking, essentially taking alpha from other participants in the market. So absolutely, they generate alpha. The two key issues with hedge funds are, one is that no individual fund is better than their institutional peers. And so that means that the wisdom of the crowd is a more consistent return than is investing in any one firm. And the other, which is probably an even bigger challenge, is that the fees are too high. And if the fees are too high, what that means is for the investor, they're generally not that much better off than were they to just invest passively. And so if you could solve those two problems, create manager diversification and lower the fees, well, that basically totally transforms the value of these strategies. And you actually see this if you go look at how the biggest institutional investors in the world build their hedge fund portfolios. So as an example, I spent a lot of time with Future Fund for Australia. What you see is that they invest in dozens of funds, essentially creating an index. It's not every fund in the world, but it's dozens of funds that effectively create an index. And what they do is they go to those hedge funds and they say, I've got $500 billion. I'm going to cut $1 billion checks into your strategies with one caveat, that you're going to cut the fees a lot. And so essentially what these big institutional allocators have done is they created low-cost, manager diversified hedge fund strategies in order to generate high-quality returns and participate a lot more in the alpha. And so all we're doing is we're just basically taking that same approach from those big institutional allocators, and we're bringing it to the world of ETFs, leveraging our proprietary replication technology.
And we're going to talk about those ETFs a little bit in the moment. I know you've got a bunch more that you're launching in the pipeline, but I'm curious about how you get access to what these strategies are, because hedge funds typically are pretty, they keep it close to the chest in terms of like, you might know their trade, but maybe you know it like a few months from now.
Well, the good thing is that there's actually a lot of performance information that's available from these funds on a timely basis, particularly not any one fund, but when you start to think about indexes of aggregate performance across major hedge fund strategies, there's daily information, there's weekly information, there's monthly information. And so you actually have a pretty good real-time sense as to how hedge funds are performing as a result of that information. And what we do is we look at that performance information and we basically back out how the managers must be positioned to generate the returns that we're seeing. And so that gives us a very timely sense of the tactical position shifts that those managers are taking at each point in time.
So I have a bunch of macro questions, but I actually wonder how much you spend applying your own thinking to what's going on with the fund managers versus interpreting what is fund manager positioning telling you, right? Like, and maybe we could pick any point during this year, whether it was like going into Liberation Day, coming out of Liberation Day, the recent freak out that we've seen in stocks over rates in November. Like, is that a better way to understand like where macro fits in for you?
Well, I think the question is, for most investors, is how do you generate the most consistent, highest quality return that you can that is complementary to your sort of existing portfolio, say a 60-40 portfolio. And for our strategies, if you just extend that idea of, there's no individual manager outperformance persistence. What that also means is that there's no individual view outperformance persistence relative to other folks. And so when asked, what is the best way to get access to, say, global macro positioning, my answer is that the wisdom of the crowd is better than my own proprietary views. Now, that is something that no person that you're going to get on the phone and talk to is going to say. Imagine a hedge fund manager who's like, you know what? I'm no better than everybody else, and I'm charging you too much, right? But that is both things are true. And so in our strategies, they're not at all my proprietary views. Instead, what they are entirely our technology inferring the position of the hedge fund crowd. And of course, at times that may be better than my personal views, and at times that may be worse. But over time, that is a more consistent outcome than whatever I would have to say about positioning in markets.
The mailbag is brought to you by BMO ETFs. If you're looking for a smarter way to analyze ETFs or diversify your portfolio, especially by replacing individual stocks with ETF exposure, BMO ETFs has you covered. With tools like the ETF Compare tool and Market Insights, you can easily identify ETFs that hold your favorite stocks, match your risk tolerance, and align with your investment goals. To explore these tools, head to bmoetfs.com and check out the tools section. Okay, well, I still want to know what you have to say. I want to take a macro walk, and maybe you can layer in, how these funds are interpreting it. So much of macro is understanding exactly what's happening with the big picture. And I feel like when it comes to the US, is it hard to understand what's happening with the big picture? Because we are sitting in one of the biggest data vacuums that I can remember in my 15-year covering the US finance. We don't really know what the US job market looks like. Even September, I don't know if that was real data because there was a big factor adjustment there, a seasonal adjustment. We don't know inflation, and yet the Fed has to make a rate decision in a couple of weeks. And I mean, the market just went from a 30% chance of a rate cut to now a 70% chance of a rate cut because one guy said, "Oh yeah, I think we're going to cut rates." That just seems so chaotic. If you're a macro fund, you don't have the macro data. What do you do?
Well, I think a lot of macro funds over time have built increasingly deep understanding of third-party triangulations on government data. And so this period has been really important because it's really separated those funds and those PMs who focus on a diverse set of data, who try and triangulate the suite of different information that's out there, from those who are really reliant on the government data as true. Now, that's not to say the government data is bad. It's just to say the government data is one of many lenses that gives you an insight into what's going on. So take demand measures. Well, there's, of course, retail sales or PCE data that are the sort of the government benchmark data, but there's also lots of third-party and other triangulations. So there's things like earnings reports from retailers who give you a sense as to what's going on. There's credit card spending data. There's same-store sales data like Redbook. So there's a bunch of different pieces of data. And so this has really been a time that has advantaged those people who are looking at all the data rather than trying to cherry pick one or another analysis in order to support their views. And, I think we've been lucky because this has been a period where, despite the fact that we've had very little government data, the economy is moving in a gradual pace in terms of slowing rather than an acute one. And so it's kind of like driving through fog, to take Chairman Powell's analogy, and getting a bit lucky that the road was straight when it easily could have not been the case.
I guess the question is, when you triangulate that data, what is it telling us about the true picture in the United States? Is demand holding up, or is demand falling off a cliff? Is inflation under control, or is it running rampant?
And what we're seeing is I'd say a continuation of where we've been with the economy sort of for the last 6, 9, 12 months, which is the U.S. economy is gradually slowing. There's, of course, ups and downs along that way. And in particular, there was a lot of weakness right around Liberation Day and immediately thereafter, as people were very concerned. You sort of saw a summer bounce in demand, and now that's starting to fade to some extent. And so, but the big picture is, the U.S. economy was running, real growth was running at 2 to 3% over the course of 23 and 24, and is now decelerating to sort of a baseline pace that's closer to 1%. And why is that? Well, the big shift in the economy has been that household spending power has shifted down considerably over the course of the last 12 months. That has been driven by a combination of the fact that we've seen job growth basically go from 1 to 2% to basically zero. We've seen wage growth moderate to some extent from 4 to 5% down to 3 to 4%. And then we've also seen inflation move back up as a function of the pass-through of tariffs from about 2.5% to 3%. You put that all together, and they're basically all creating a squeeze on household spending power, which today in real terms is closer to 0 to 1% than it is 2 to 3% real. And that is an important transition in this economy that so far has not been fully reflected in financial markets in terms of the likely subdued demand that we're going to see ahead.
I wonder if we can just boil this down to, what does the Fed end up doing? And in your history of tracking the Federal Reserve, has it ever seemed so chaotic? I don't know if that's the right word. Like the last Fed meeting, there was somebody who said, keep rates the same. And then another person who said, cut it by 50 basis points. The Fed speak this month is all over the place. Some saying we should raise, not raise, but kind of keep things on hold. Others saying, yeah, we're ready to cut. And then we're waiting for a new Fed chair, which presumably, like the first question in that job interview is, do you think rates should be lower? Right? Like, how do you deal with that?
I know if I was being interviewed and I wanted the job, I think there's only one answer to that question, right?
That's right.
I think what we're seeing from the Fed is in some ways a real conflict that exists when both sides of the mandate are moving in opposite directions. Unambiguously, inflation is above the Fed's mandate. Right now, the Fed has at least acknowledged that it's probably going to be 80 months plus where they've failed on their inflation mandate. And at the same time, we are seeing the job market soften, whether it be the unemployment report, which came up at 4.4%, almost 4.5%, or other third-party triangulations, which are largely the same. Those two things are in conflict. And when they're in conflict, the question becomes, what is the prioritization of the two pieces? And so I think that's where what we're seeing is that this is more a question of the reaction function and trying to describe the reaction function, which unfortunately remains pretty opaque. And even worse is you've got a whole bunch of people saying, everything from, there's a bunch of people on the committee saying things that independently could be totally reasonable. For instance, it could be totally reasonable to say, let's prioritize the labor market and cut significantly here, which is something, for instance, that Myron is saying. Or it's totally reasonable to say, hey, look, inflation is still a big concern. Let's keep rates where they are. The problem for the market is that there's no clarity about what the reaction function is. And that is the predominant failure from this Federal Reserve, is not giving us any clarity, or even worse, switching the reaction function. Just the difference between what was said in July and what was said at Jackson Hole, totally different implied reaction functions coming from Chairman Powell. And that ambiguity is honestly a sign of pretty deep dysfunction in terms of the decision-making process.
And that switch was up until Jackson Hole. It seemed like we were more concerned about inflation. And then in Jackson Hole, he said, well, now job growth is slowing. Maybe that's our primary focus. Then you have to throw AI into it. And there's AI and what it means for the stock market. But all of this spending is also showing up in economic growth. And I don't know if Powell ultimately will eat his words, but he himself said, the AI companies, it seems like it's stable. They're generating profit. It's different from the 2000s. But AI as a growth driver for the U.S., do you think that that's fully appreciated, how much it might paper over something like weak job growth, that it is stimulating GDP right now?
Well, when you think about the AI investment, you see numbers like $400 billion of investment this year, or $500 billion coming down the line. And those numbers seem really big, right? Hundreds of billions of dollars of investment. But in reality, against a $30 trillion economy, they're pretty de minimis. And so, of course, in one quarter, they could be supportive to growth, or another quarter they could detract from growth. But what really matters for the U.S. economy is the $20 trillion annually spent by households. That's what matters. In addition, even when you talk about fixed investment in the corporate sector, total fixed investment in structures, et cetera, in the corporate sector is actually zero. Because all AI, all this data center type investment is doing is it's just kind of propping out what would otherwise be pretty weak corporate investment. And so I think if anything, there's too much focus on the AI investment boom, or you call it boom, it's fine. The AI investment boom.
It's definitely a boom.
Yeah, it's definitely a boom. Narrowly in that area, the AI investment boom, there's too much focus on that and not enough focus on the core fundamentals that'll drive the economy. And in that context, the thing that really matters for the U.S. economy is not, how many data centers we're building in rural areas and random places across the country. That doesn't really matter in any time frame that investors should care about. What really matters is, are we going to get productivity out of all of this AI innovation? That's the real question. And when you look at that, what you see is that there's been a lot of investment that's come into that space, hundreds of billions of dollars of investment. And there's very little indication of real world earnings or revenue that's come from it. And there's lots of revenue from investing that's come from it. NVIDIA being, NVIDIA, of course, making plenty of money, right? That's because they're capturing a lot of the high value fixed investment that's going on in that sector. But the question is not, is NVIDIA making a lot of money? That is an irrelevant question to this over a medium-term time frame. The question is anyone else making money applying AI to real-world outcomes? And there, I think stories like Meta is much more interesting, because essentially all of Meta's revenue is in real economy type activities. It's traditional advertising. And what you see there is Meta's investing, $70 billion, $75 billion a year in AI infrastructure. And maybe you could argue that they've increased their revenue by like a few $1 billion a year. Like, okay, that is a terrible return on investment, particularly for something that has a decay rate of about 5 years. That looks like a negative ROI. And I think the challenge in the economy, to circle back to the beginning of this question, is the challenge is that these companies that are doing all this work are so cash flow positive because they have good sort of old co businesses that they can actually blow tons of money on this activity. And it's fine because they'll still be, free cash flow positive. They're not going to go under. But it means that actually the waste that can exist in this space can be vastly more significant than what we saw during the dot-com era.
I think that's so important to highlight. Everybody looks at the profit picture as a reason that we're going to be safe. But you just said the fact that they can waste or spend this amount of money and still be profitable means that the bubble could grow to be that much bigger. And you're seeing it in other places too, right? It's seeping into the private markets as well. I wonder if you could extend out to, you said on one hand, like AI is just a small piece compared to, say, the consumer, but this can bleed into a bunch of different sectors, right? All that excess.
I think one of the places that's probably the most interesting space that the AI story is starting to impact is related to private credit and credit in general. And so one of the areas that, if we go back to that story about the tech boom and the dot-com boom and bust, the area that eventually created the threat and downfall of all of that investment was in the credit markets, when companies were borrowing a lot to lay fiber that wasn't going to get used for 25 years and things like that. And they didn't get the revenue that was necessary. And eventually it was the credit markets that called the bluff on the whole thing. And I think we're starting to see that a little bit, whether it be in specific companies. So like you see like Oracle has to issue a bunch of debt in order to do their activities because they don't have nearly as strong a legacy business the way that a Meta or a Alphabet does. Or actually one of the more interesting areas is where a lot of the data infrastructure, the data center infrastructure, is being financed by debt sort of away from, or at arm's length from the hyperscaler investment that's actually occurring. And that's interesting because we're starting to see the entities that are engaged in that credit extension starting to see pressure. So the Blue Owls of the world who basically built whole private credit businesses on lending into this AI boom, those markets are starting to, the markets are starting to punish those folks in terms of seeing that maybe some of that credit is not going to be paid back. And so you put that together, and we're starting to see, that's sort of the leading edge. You'd expect the way that this is going to see, and not much different from what you saw in the housing crisis and in the dot-com era. It's always sort of the most questionable debt-laden entities that start to create the tremors in the system that then start to feed back into the rest of the economy. And that's, I think, what we're starting to see here.
Maybe that's even healthy though, right? Maybe it'd be unhealthy to see Oracle ripping despite some of the issues that they have, right? The fact that their biggest customer is losing $11 billion a quarter, and we don't know that it's going to, an open AI, and we don't know that if it's going to pay Oracle. A lot of people that I've interviewed, some of them have said, we're not going to have a dot-com era crisis because the simple way is we're still talking about it. So we know what the mistakes were, and maybe in some ways we know how to sidestep it. What do you make of that argument?
I mean, it just comes down to what the ROI is of all of these things and how much expectations have been built from it. Right now, essentially, if you just one of the interesting things is if you look at, there's obviously very high expectations in the sort of Mag 7 sort of core hyperscaler names. But one of the more interesting things is there's also a lot of expectations baked into the 493, right? The everybody else, that they're going to get a lot of benefit from AI, advancements bleeding into the rest of their business. And so I think that's kind of the question. is when you look at the Mag 7, or really the hyperscaler world, what we have is a set of expectations where kind of every single entity in the business is being priced as if they are going to be a big winner. And if you think about that, what you see through time with technology is almost always there's one or two entities that capture the vast majority of the gains. And the market action in the last, I'm not like a single stock person by trade, but like the market action in the recent period is actually kind of interesting. Like you're seeing, NVIDIA fall at the same time that you're seeing Google rip, because Google is making a case that they can, run their models on their own chips that don't rely on NVIDIA. Again, I don't have a particularly strong view on one versus the other, who will be more successful than not. But it highlights that if we transition from everyone wins perspective, that is pretty impossible. I mean, even the A16Z type people, the real techno optimists will say not everyone will win. To a world where one wins, well, then there's going to be a lot of pain. And then, of course, there's the real challenge, which, essentially no one in the U.S. market wants to talk about. Like, what if the Chinese win? And what if the Chinese win in a product that is essentially zero marginal cost for people rather than significant cost for people? That would be, what if what wins is small scale models run on laptops? Like, who wins that? That's really the question that I think creates a lot of challenge. Where what's priced in the market now is every single entity is the primary winner of this dynamic, and the reality, it just can't be that way.
So to win, you need to either diversify some of your exposure, or not, have it such a significant weight of your portfolio. But I mean, you're even using AI technology. So it'd be silly to say that this is not going to be a useful technology. And if I'm understanding you correctly, one of the risks is, yes, you don't get that return on investment. The risk before that is that that there's a funding crunch before they're able to prove that there is a return on investment. And that's basically what happened in the dot-com. We still got the internet and it revolutionized the world. But first, there was a funding crunch. And so if people are thinking about their risks, this is not to scare them out of the sector, but this is to understand this is the risk, the funding. And I wonder if it goes back to rate cuts, right? If the Fed doesn't cut rates, like, is that ultimately the needle that pricks things for a little while?
Well, yeah, the Fed, one of the ways that this could play out is that the Fed could keep money tight. I think the challenge with that is that the Fed is not likely to keep money all that tight. I think, it's kind of interesting if you just contrast where we were in early 2000 under Greenspan. We had unemployment rates that were kind of in the low 4s. We had inflation that had ticked up to about 3. We had relatively strong growth in the economy, and what did you see? The Fed tightened 75 basis points. So today's Fed is very different from the Greenspan Fed back in the day. It's kind of interesting. Everyone sort of talks about the Greenspan Fed as if they inflated a bunch of bubbles when their behavior looked very orthodox with any historical perspective. Looked back on history, they seemed very orthodox versus today. I think the challenge, the Fed is kind of sidelined at this point, in part because if you take a look at this circumstance, it's not like any hyperscaler is investing because interest rates are 3.75 versus 4. Basically has no impact. I mean, similarly, if you look at the housing market, I think mortgage rates have come down almost 100 basis points. And what's happened to the housing market? Like, nothing. That's the answer. Nothing has happened. There's basically no impact. Like, I see folks sort of charting the mortgage rate against like the tiniest squiggles on existing home sales. And it's like, look back over the last 30 years. They are at a 30-year low. Like, who cares about the wiggles? Right. And I think that highlights that the Fed has really, is in many ways, in the same way they were inept at controlling the economy, slowing the economy on the way up in terms of rates, they're probably pretty inept here at stimulating the economy with rate cuts. And so what it'll really come down to, I think, is whether you see the cash flows coming from this investment justifying the amount spent on it. And that's really where the rubber's going to meet the road. And, we see waves of this last couple of weeks. We've seen a bit of this story play out where there's been some concern. The question is, how long is it going to take before the euphoria starts to wear off?
Now, let's talk about how that shows up in the US dollar, parking kind of that conversation around AI. If directionally the Fed is more dovish, do we see a weaker US dollar for a sustained period of time? And here in Canada, Canadian equities are outperforming in part because gold has done very well. You have a bunch of commodities except oil. You have a bunch of commodities that are ripping higher as the US dollar has been in kind of this, 1 year long downtrend. And I think that that's significant. Gold moved higher even though as the US dollar was advancing, but now it's significantly lower. I think understanding the direction of the US dollar is also really important for a bunch of other assets.
The US dollar and I think currencies in general, we've transitioned a fair amount over my career from a very debt-driven story when it comes to exchange rates. So, those economies with higher interest rates largely receiving the vast majority of the flows and stronger performance, to an environment where essentially equity is the primary driver. And that's a very, very important transition, because what it means is that some of the sort of classical currency intuitions that people have might be evolving. So, for instance, easing could actually be good for currencies to the extent that it props up domestic equity markets or the domestic economy. And so, similarly, you could easily have a circumstance where if you start to see equity declines, that could engender a pullback in terms of interest in a country's assets. And so I think the U.S. is kind of interesting from the perspective of where is this going to fall, because a lot of the flows that have been propping up the U.S. markets over the course of the last sort of post-COVID period have been a lot of institutional flows that were unhedged from foreign investors. And if there's any question about whether or not the U.S. equity market's going to continue to outperform and take over the world when it comes to market share, then we've got a real question about whether those flows into U.S. equities are going to continue to support the dollar. And so we may well see a flip here, a concerning flip, because the asset management community is really structured itself in a way that is set up for when the dollar rises or when stocks fall, the dollar rises, right? That's kind of the intuition. Portfolios are constructed that way, correlations and things like that. If we move to a world where the opposite is true, where the dollar falls as stocks fall, that's going to be a rude awakening for many global investors.
Do you see that playing out?
Well, you see it to some extent. Over the course of this year, right, you've seen the dollar fall. You saw the dollar fall during a period where equity markets were under pressure, for instance, around Liberation Day and things like that. And I think that's kind of the question is, which regime are we in? I mean, now, after that, the dollar sort of stabilized during a period of strong equity performance. And so I think that's kind of the question is which sort of environment are we going to see from global investors? Are they going to start to pull back? Or it's not even that they have to pull back their U.S. equity investment. They could just start to hedge. Like, basically what happened over the course of the last 15 years is every global investor who was buying U.S. stocks kind of forgot about the currency part of the story, right?
Well,
and now they are remembering the currency part of the story.
And hedge funds love this strategy. I think it's important to understand, even if you follow the markets on a surface level, you might hear every now and then you'll hear about the yen carry trade, and the yen carry trade always threatens to blow up markets, right? And I feel like we're again talking about it. The yen carry trade is when you borrow in yen and you, which is low, and then you invest in other higher interest rate or higher yielding environments. So borrowing Japanese yen to buy U.S. stocks, very popular. Except if rates are going up potentially in Japan. And that seems to be a situation that we're in right now, although there's a bunch of fiscal stimulus being thrown at Japan as well. Do you spend much time thinking about the yen carry trade and what it could do?
Well, I think Japan, I spent a lot of time thinking about Japan and have had a really non-consensus view on Japan for a long time. And that view was that nothing would happen and the yen would keep remaining weak, right when basically everyone in the West was applying a Western framework, inflation too high, needing to tighten sort of framework to Japan. Like, I think the real question in Japan continues to have incredibly difficult structural problems, which, for those who are familiar with Shinzo Abe's three arrows, were starting to be addressed. He had a big policy push a while ago, which was more fiscal stimulus, more monetary support, and significant structural reforms. And I think the problem is, the problem has become basically those things made good progress, but were stunted before they could fully allow Japan to get to to escape velocity from its malaise. And so we're going back, actually, in many ways in Japan to an environment of malaise that's being reinforced by the BOJ. The BOJ is tightening monetary policy at a time when the economy just printed a contraction for third quarter growth. Like, the Japanese economy needs more stimulus, not less stimulus. And so probably what we're going to see in that environment is we're going to continue to see, the currency continue to be weak. And we're probably not going to see all the tightening that many people expect until Japan has a sufficient adjustment in either its productivity or in its exchange rate down, that it starts to become competitive on the world stage. But unfortunately, I think I sort of always joke that Japan will run tight monetary. The big question is whether Japan will run tight monetary policy before I retire. And right now, it still doesn't look like it's going to happen.
All right, long live.
And I'm pretty young, so just
long live the carry trade. We're going to spend some time in ProPicks looking at your hedge funds or looking at your ETFs that replicate some of these hedge fund strategies. But before we get into that part, I'd love to just get thoughts on gold. Again, very relevant to Canadian investors. Took off like a shot. Really, maybe not a shot. Slow outperformance starting in 2022. Then really took off like a shot over the last year. And the question is, does that momentum continue? And to what extent are hedge funds participating in that? Like, when did they wake up to the gold rally?
Yeah, gold, I think you want to think about gold sort of from two different perspectives. One is as a strategic asset as part of a long-term savings portfolio. And the reality is the vast majority of investors don't hold enough gold. Like, they're up to their eyeballs in bonds and hold no gold. And that doesn't make any sense, because if you look back through time, through a wide range of different environments, having gold in your portfolio, gold does better than bonds in about half of equity drawdowns. So, you should basically have half your stock diversification risk in something like gold in addition to bonds, and yet nobody holds gold. And it doesn't make any sense. And I think there's sort of legacy reasons why people think of it as an asset that they don't want, even though there's tons of empirical evidence. And so I think what we're doing is we're sort of gradually recognizing in the West that including gold in a portfolio is probably a good idea. And then there's, of course, and that's been an important transition as demand for gold has moved from predominantly just being in the East and amongst global central banks to also now starting to grab the attention of Western investors, with a long way to go. Then, of course, there's a tactical point, which is, sometimes that process gets a little too exuberant, and sometimes it fades, and sometimes it gets exuberant and fades. And post-Jackson Hole, we basically had exuberance across all financial assets. Gold benefited from that. And that exuberance, drove it to 4,400. And at the time, having been a gold bull for a very long time, I said, look, that looks a little too extreme, a little too manic from my perspective, and maybe it's time to take some profits. And that's basically what we've seen. And this consolidation phase, essentially, the longer that this consolidation phase lasts, the more interesting it is as an asset from the long perspective on a tactical basis. And we probably have a little bit more to go on that sort of consolidation, but the big picture drivers of why gold is likely to be a beneficial asset in a portfolio, those are largely unchanged, and so it's the sort of thing that most investors should continue to think about, sort of going through a process of legging into, dollar cost averaging into as part of a diversification strategy in their portfolios.
Okay, well, let's look at these hedge fund strategies that you've got in your ETFs. We'll take a look at ProPicks. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. All right. The first ETF, which is the longest running one that you launched it a couple of years ago, is your multi-strategy return tracker. The ticker on that is HFND. And basically, this is your bread and butter. This is what you're trying to replicate, the aggregate hedge fund industry returns. What does that look like? What's inside of this? And what's the goal for advisors, or for investors, I should say, if you're holding an ETF like this?
If our original strategy was really focused on proving out, it was basically a proof of concept of our technology. And so what we've done with that strategy is we took the 6 major hedge fund styles that hedge funds pursue, and we built an individual replication for each one of those, and then we combined the strategies together, essentially to get a single product that tracks hedge fund industry returns over time, and then of course doing so at a lower cost point than you'd get if you were investing directly in the funds. And so the product, in many ways, was really focused on a proof of concept. For some more conservative investors, they found it useful because it does pair nicely with a 60-40 portfolio over time, in terms of providing a bit of diversification, because it creates, through the cycle, it's expected to have 60-40 like returns, but just with lower volatility and lower drawdowns. And some clients that we work with who have more conservative portfolios find it useful because it's only run essentially consistent with how institutional allocators run their hedge fund portfolio, which is to run it at something like bond risk, seeking a few hundred basis points over cash.
That was actually going to be my question, because if you look at how it performs against the S&P 500, it would have been better just to buy that index over, the last 1 years, even in 2025. So that's not the goal. It's more bond-like returns or preservation of capital versus return on capital.
Exactly. So it's in many ways you could think about it as just a spy for the hedge fund industry. And so the goal is to track hedge fund industry returns. Most institutional allocators target cash plus a few hundred basis points in terms of the goals for their returns. And so that's what the strategy has delivered. And probably more importantly, the goal of the strategy is to demonstrate that we can track how hedge funds are performing and positioned in real time, because that then has created the basis to be able to create some of these new strategies, which don't just take hedge fund returns as sort of a given out of the box, but helps transform those strategies into something that can be more cash efficient and complementary to portfolios.
So one successful example of that is the one that you launched a couple of months ago, the Global Macro ETF. The ticker on that is HFGN, and this is actively managed. In the time, it's only short period of time that it's been out on the markets, July, as I said, but it's doubled the returns of the S&P 500. Talk to me about the active component and, what it seeks to do relative to the S&P.
Yeah, what we've done this year across a couple of different strategies is we took, as I mentioned, those 6 hedge fund styles that were in our multi-strategy portfolio, and we broke out basically 3 of the most valuable of those strategies individually, and the Global Macro one being one of those strategies, along with managed futures and equity long short. And instead of running those strategies in the same way that institutional allocators run them, which is at bond-like risk. What we've done is instead, we're running them at a 2x target return, which is something closer akin to equity index risk rather than bond risk. And that's really important because what it does is it makes for a much more cash efficient exposure to those individual strategies than where you invest in a hedge fund directly, in those hedge fund strategies directly. And of course, they're run at a much lower cost point than what a typical hedge fund investment would be.
So sorry, just flesh out what's different then when you say run at 2x, like, is it leverage or what do you?
Well, through the use of futures contracts, we effectively take on twice the notional exposure
I see. Okay.
that the managers would have on run at sort of bond-like risk. And so that's really what we're doing. And that brings it, I think, in for a lot of investors when they're looking at some of these, looking at diversifiers, they want to look at those. They want the diversification without giving up the return potential, right? And so I think by targeting equity index-like risk, we're able to balance those desires. Global macro in particular has done well this year. Interestingly, because of its ability to be flexibly long and short assets in a wide variety of different environments, one of the interesting things is if you look at global macro strategies over the course of, say, the post-GFC period, the two periods where global macro has done the best have been in this most recent period, where essentially all assets have gone up and macro strategies have been able to take advantage of that. And in 2022, when all assets went down. Why? Because they could go long and short. And so in a lot of ways, when I think about the global macro strategy, it's in many ways an all-weather alpha, the sort of alpha strategy that can provide diversification benefits both in down markets and in up markets. Highly
correlated markets, though, sounds like. All things going up, all things going down.
Well, it's a question of whether there's what are the big macro drivers, right? Because that's basically what determines outsized performance. And so, as a simple example, when you say everything going up or going down, in 2022, global macro managers made a ton of money. They were short stocks and bonds and long gold and oil, right? So it's not everything going up. It just happens that in this period, essentially, easy money relative to conditions, and particularly around Jackson Hole and the shift of the Fed's reaction function, that's been a really important driver of lifting all asset prices. And so that's what macro managers have taken advantage of.
How would you pair that against the HFEQ? This is your equity long short. So how is that different from maybe your global macro?
Yeah, the equity long short strategy, and if you look at most long short equity hedge funds, they are not market neutral. They are taking, they generally have a positive exposure to equities and then are adding alpha strategy on top of that, meaning trying to add additional returns beyond just passive investment in equities. And so in many ways, what you can look at that strategy and think about it as as competing with other actively managed equity products. And we've written about this actually on our blog at unlimitedfunds.com. If you look at hedge fund equity long short strategies relative to all the actively managed equity strategies in the market, what you see is notable outperformance of hedge funds relative to sort of traditional mutual fund actively managed equity or ETF active managed equity. And so that's really what it's competing on. So maintaining that equity exposure and looking to add something on top.
What is the managed futures ETF looking to accomplish? It's flat since launch. The ticker is HFMF.
Yeah, managed futures, for those folks who don't follow, is really about trend following, and that those sort of trend following strategies generally demonstrate uniquely differentiated performance during down market environments, particularly where we have long cycles of down market environments. And the reason why that is because they're typically strongly following price action in terms of creating positions. And so if you have stocks falling for an extended period of time or bonds falling for an extended period of time, they do particularly well. And so with those strategies, I think a lot of folks are interested in those sort of defensive style strategies, particularly ones that have over time a positive return. So ones that aren't essentially like a tax or an insurance policy, but have a positive return. The challenge with those strategies is you got to stay in them until they pay off. And one of the ways that you can do that is by having a more cash efficient exposure to those strategies. So in dollar terms, it's just a smaller line item on your portfolio that you can stomach. Sure, this thing's chopping sideways for a little bit, but it's there to help protect me in the event that there's an extended asset market drawdown. And so by offering that strategy at a 2x target return, that basically helps improve the cash efficiency and keeps folks more into those strategies than if they invested at a lower expected return.
Bob, it's been an absolute pleasure. Thank you so much for joining us and spending time with us today.
Thank you so much for having me.
That's Bob Elliott joining us of Unlimited Funds. We're going to continue our look at the macro picture this week. Our next episode, we've got Bipin Rai. He's the head of ETFs and alternative investments at BMO Global Asset Management. Don't miss that episode. It is coming out on Thursday. We'll catch you next time.